You've high conviction in a lot of your thoughts, your beliefs, especially some that are very contrarian. Where do you think that conviction comes from?
Being an egomaniac? No, I don't know. I don't know. I think I just study, like, I care about the craft of like investing a lot. And so I care a lot about it.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. This week, we're talking to Mike Dempsey, managing partner at Compound. Mike is one of the best investors I know, having broken the 100x multiple on invested capital threshold several times. Joining us as co-host is our good friend Kesar Varma from Upfront Ventures. Mike and Kesar, thanks for joining. Mike, to kick things off, what's the best investment you've ever made?
I think there's probably a few, I guess. We could, one, think about crypto as an asset class, and obviously the returns there have been pretty parabolic. And then there's others that are still to be determined that, we're really excited about, companies like Runway and Wave and AI Fleet and a few others in our portfolio that, are now kind of very highly valued, large scaling businesses. But I think the main thing is, until the companies are exited and liquid, it kind of doesn't matter.
What if we break it up into just realized, unrealized? And you can, if you want to be immodest, you can give us the actual multiple. If you want to be a little more modest, you can give us the entry valuation, the current valuation, something like that, maybe.
Yeah, both of north of 100x multiples, and in some cases larger than that. Neither of those companies have publicly disclosed valuations at this point, but both of them we kind of led the seed rounds at sub $10 million post money valuations, and they're now $1 billion plus companies. And we've partnered with them multiple times through seed, Series A, Series B, and then have also raised outside capital in kind of SPVs to finance both of them in Wave and Runway. On the crypto side, we started investing in crypto in 2016 out of the fund. I think my first Bitcoin purchase was maybe 2014, 15, but really only sizably started owning crypto post 2016. And we've been fortunate enough to back some protocols very early as their seed investors. One of the more notable ones would probably be Arbitrum, which is a layer 2 network for Ethereum. Today, I think fully diluted value basis trades somewhere around 7 billion. I'm not entirely sure of price, and we invested at the seed round.
Is there a difference in the process that you guys have when you're looking at a crypto investment versus something that would just come out of the fund normally? And I'm curious also, just from your perspective, is that still the entirety? Are you working with the entirety of the team, or is it specific people at Compound who's evaluating those different decisions?
Yeah, I think Compound as a firm is built around the idea of a collection of experts who all have a unified view of how to invest. And what we deem that investing is research-centric, thesis-driven investing. And that means building a collection of futures we believe in, rooted in science and research, and figuring out where do we think value is going to accrue in a selection of categories. And the core thing being we enter these categories early. These categories typically carry large science or engineering risk, and we stay in them through multiple cycles. AI for multiple cycles, crypto for multiple cycles, robotics now. We think that's going to continue. And then there are new things on the horizon in the periphery that we allocate smaller dollars to. Crypto in 2016 was, one of those kind of peripheral areas where we were maybe more collaborative, wrote smaller checks, higher velocity, and really because we didn't know how the financing of those projects was going to work long term. We didn't know what liquidity timelines were going to look like. We didn't know what dilution was going to look like. We didn't really know how to value these assets. Even today, people still don't. And so I think now on a go-forward basis, we underwrite crypto slightly differently. We still are maybe more collaborative than we are traditional equity investing. We write smaller kind of collaborative checks because we think that's more true to the ethos of crypto, in which no single entity holds too much of the control of a given network. That's kind of core to decentralization. And we also assume less dilution over time because these protocols typically raise fewer rounds privately before issuing a token and having a token genesis event and kind of distributing ownership over time. Team-wise, I think everyone kind of I sit across investing in a bunch of different areas. Our core areas are machine learning, AI, robotics, bio, and crypto, and then kind of 20% these adjacencies. But Smack on our team focuses exclusively on crypto. Shelby focuses exclusively on bio. But as these categories kind of move from verticals to horizontals, they start to overlap. So Shelby has done a bunch of kind of research in the decentralized science space alongside Smack. And Smack, I think similarly as an investor, is very much kind of thesis-driven in his approach of how he looks at the world. And a lot of his ideals around the world have manifested themselves through crypto investing, but he every now and then will talk through kind of material science stuff or energy-related investing. And so as a team, I think we have our lanes, but everyone kind of has the ability to make an investment in any category, theoretically.
I want to ask you about crypto because you made those investments before Smack, before a lot of people were investing in crypto, and you obviously have also like made the crypto to AI pivot before it was cool with Runway and Wave. But in 2015, 2016, can you just take us back to where you are? This is like pre-NFT, pre-ICO, and you had the foresight or the conviction that this is going to be something. Where did that idea come from?
Yeah, I'd like to say I had the conviction it was going to be something. I think actually the reality is like our job as venture investors is to understand when things could spike and when things are like asymmetrically skewed to the upside. And so I think a lot of it was Josh on our team, who is a founder in our portfolio now, was really into crypto. And me and him were doing a bunch of research, and he would basically send me different white papers every week and we'd talk through them. And I think he was actually very high conviction, very ideologically aligned. And I think as I spent more time, I was like very intrigued. And I kind of just felt like if it works, it's going to work at some scale that will make venture style returns. And anytime there's a collection of really intelligent, weird people focusing on something that could be kind of like a multi-generational trend, our job as investors is to understand it. And maybe what we do at Compound best is doing hard things that a lot of lazier investors don't want to do, which is like digging into new areas and saying, okay, how do we understand this from like a native point of view versus a pattern matching point of view? And I think that's something a lot of investors try to maybe be lazy about over time. They kind of think that they're going to pattern match their way to like 30 years in venture. And I think that's just like totally bullshit, honestly. And so we kind of approached it from a sense of like, how do we do the same type of research that anyone else building in the space and or who is dedicated to the space is doing. And I think it kind of comes down to like the famous Chris Dixon thing of like study what people are doing on the weekends. He has that post from a long time ago. And I think now it's just kind of more about taking that approach from understanding where interesting people are. And in that time it was the Ethereum ecosystem, and then understanding where like science or technology can take you. And if you can marry those things together, that's great. The complexity with crypto probably is like in 2018, one with the ICO boom, and then 2021 with ZERP. There were a few people who were maybe like ideologically aligned versus, and even intellectually aligned versus capitalistically aligned. And so that's sometimes things you have to look at in these cycles, which is kind of, one could argue what has happened with AI a bit. I think AI, people are capitalistically aligned because they see the ROI on the technology, but it definitely still has its problems of under-inspired founders building companies that are not actually long-term durable or matter long-term.
Yeah. What was it? I guess that was the first real investment or action that you took in that beyond reading white papers. Was it buying Bitcoin or ETH? Was it making a fund investment?
It was a venture investment. So I mean, I personally had bought ETH at that point and had owned Bitcoin already. But in the fund, we basically amended our LPA and said, hey, we're going to be making investments into crypto assets, which are, they have a different structure. In that time, it was, you started to have things like equivalent to a SAFT, or you'd have some sort of token warrant attached to a traditional equity investment. And half of our LPs were kind of like, cool, we don't like whatever you do. Maybe a small subset were like, crypto is the thing that people use to buy and sell drugs. Like, why are you guys doing this? This is all scams. And we kind of just did it anyways. And we made maybe a variety of investments in 16, 17, 18, and then 19 and less than 20 and a few in 21. And then we also did two things, which is we invested in two funds that were like crypto native funds. So we helped back Multicoin team early on as they raised their first fund. And then we also were then LPs in Nick Tomato's One Confirmation Fund. And both of them were very different ideologies, but very kind of like hardcore all in on crypto. And we thought being able to spend time with them as some of the more serious and thoughtful investors in the space would help us accelerate our learning. And at that moment in time, it was also just very different because crypto was so collaborative. There was probably realistically like 8 real investment firms at the time. And it was like, USV, Andreessen, us, Nick, Kyle, and Tushar at Multicoin, and maybe a few others on the venture side, even fewer, that were doing it in crypto native protocols versus like Web 2.5 type businesses that looked like Coinbase, et cetera.
Since 2016, there's been a lot of, I think, crypto cycles that we've gone through. And I'm curious, what has kept your conviction in the space?
Every year that goes by, the principles that underline crypto become more and more obvious to me. And maybe it's because I'm looking at it more and I have more of like an interest in the world outside of my bubble of living in New York City. But also think about the way the world changed from 2016 to 2020, and then the way the world changed from 2020 to 2024. You just see more and more distrust of institutions. You see more and more people who care about having like self-sovereignty. You have more and more ways in which smart contract platforms have actually matured such that they can do valuable things. Every year, it's something different. I think in 2016, my view was like, there's just no way. I'm like somewhat quite dubious that people don't want someone to call and yell at the end of the day, and they want someone who's kind of holding their hand and watching their back. And in 2024, I'm kind of like, there's no way people actually want that in most cases at varieties of scale. And so I think like the question is just market size, not like market reality, in my opinion. And I think the market's going to be very large, but I can understand why some people think, decentralized finance in the United States won't catch on for a variety of reasons. I disagree, but there's a bunch of nuanced conversations one could have that at this point, I'm kind of just tired of debating the like crypto doesn't matter thing.
What was the thinking around investing in funds? That seems pretty atypical, out of the realm of normal to do.
I think it was just that like it was such an open field that it felt very accretive to our long-term plan. I think like one of the things that we care about at Compound a lot is like we do a lot of things to optimize having successful funds, and we do some things to optimize having a successful firm. And there are sometimes things where those are different. And one could argue, investing in as an LP in a venture fund that does crypto is not going to have the same return profile as investing in a crypto protocol startup, right? Like it's just different risk returns. That's mostly correct. I will say our kind of investment in Multicoin has paid off venture-like returns. Those people are incredible at managing money. But I think that was more just like we believe in this long term, and so we want to be with the most native, most interesting, deepest thinkers. We want to be aligned with them, and also we want to. At that time, it was like I wouldn't say we helped them, but we wanted to at least continue to align ourselves with them and help them any way we could. And Josh had a close personal connection to Kyle, and I spent time with Kyle and Tushar, and Josh knew Nick pretty well as well. And so as we kind of sat down and got to spend more and more time with them, we just kind of felt like the world was very small, and there's very few times in our careers, and it was the first time in my career where you'd kind of been able to see this is like the birth of a new ecosystem. If we believe in the ecosystem and we can help push that ecosystem faster with some of the best people, why wouldn't we, for relatively small dollars? So yeah, so that was why.
Was there ever a point where you felt dubious or skeptical about your own decisions, or like you had people who were giving you resistance that made you second guess whether this was a place you should be investing?
There's definitely times where I was like, late 2018, early 2019, maybe? There were a few times where I was like, wow, that was pretty crazy that we did a bunch of that stuff.
This is like post ICO crash.
Yeah, like I think our portfolio probably drew down like 90+% in that time frame. Wow. I don't think it was maybe more of like, should we continually invest versus like, was it bad to have invested? I think that like the beauty of venture is like you can kind of reason your way around making most decisions within some sort of risk reward band, and where you get burned is maybe when you scope creep too much. But like, I take a lot of solace in the fact that if you invest in Compound as an LP, we are like probably your riskiest dollars, big period, in the fund management side, right? You might do direct angel investing or something, but there's no place that is less risky than like, Compound. I think the types of things we invest in, the scale which we invest in, we have a good track record, but we're not like a 20-year and durable brand, and we're seed stage only. And so there's really a lot of wiggle room to lose people's money if you do it with the right fundamental inputs, in my opinion. And I think, again, our goal as a firm is to continue to build such that we have built a firm that is built around kind of being consistently great at returning money and having the chance to be incredible at returning individual funds, which is kind of why you invest in seed. Otherwise, like if you wanted to compound to like 12 to 15%, there's a bunch of ways you could do that. It's probably better expected value for your money.
This was like a good time to ask you about like fund returns as much as you could share about that. What's like been your best returning fund so far?
Yeah, I mean, Compound One is a $48 million vehicle, and we've returned more than the fund, and more. And I think today is marked at north of a 7 or 8x somewhere. Yeah, and I think our job is to convert as much TVPI into DPI, and I think we've done a good job at that. I think we always could do better. And Compound 2 is a $73 million vehicle, and who knows? We'll see. So it's still early. But I think in general, our entire strategy is like, actually, we care more about the inputs being correct, because the outputs are within certain bands, like pretty unknowable. I always say like the delta between a company getting acquired for $1 billion and like $2.5 billion is like, very unclear. Companies going public, you have more clearer bounds. But because of that, we just mostly care about like underwriting, making sure we have the right ownership when we enter, the right sizing positions, the right follow-on investing, making sure we're not just blindly follow-on investing over time because some other firm is doing it. And so, I think there's a lot of people who've gotten lucky and have done one fund okay. I think our first fund is going to be that at least. Our goal is to do it like 3 to 4 times in a row, and then we'll know we're like really fucking great. And that's the plan.
What was the moment where you said, okay, it's time to have a completely separate crypto fund?
We don't have one.
Oh, well, that moment hasn't happened yet.
Yeah, we've thought about it. I think that's the perpetual problem, or the perpetual thinking is that people want discrete vehicles, and LPs specifically want discrete vehicles to this point of like risk capital. People want to have a bucket for the risk that they're taking with you. And as much as people might love me or Smack or Shelby or anyone on the team, they don't have a discrete bucket for us. They have a discrete bucket for the asset that we're investing. And so that is kind of the main reason why I think someone would do that, why we've thought about doing it. I think for us, we like the idea of a single vehicle that expresses our views on the world over a 10-year period. I think it is more likely that Compound will continue to do versions of that maybe have weird nuances relative to traditional venture. An example is within both of our funds. We have the ability to infinitely recycle capital in crypto markets. And we do that for a variety of reasons around our liquid positions that we take, as well as some of our venture investments. And I think there's probably other areas that we will continue to push into, but the goal is like, you want to scope creep a little bit to prove that you're able to execute on your strategy, perhaps, but not too much to prove that you got far out of your skis. I think most seed managers have done that part really aggressively in the past 3 to 5 years by expanding fund size too large and trying to raise these opportunity funds and do a bunch of stuff that isn't really core to their job. And when you get down into like the underwriting of some of these things, it's pretty hard to understand why it's dominant from a GP perspective, or an LP perspective rather. And you can understand why from a fee perspective, it's dominant for the GPs. But I think that we've never really done anything from a fee perspective. I mean, we could have raised more money both times we've raised funds, and we didn't. I think our next one will probably similarly be not that large. And again, we want to be really great at what we do, not like good and rich off of management fees.
What's, in your opinion, the biggest difference between Fund 1 and Fund 2?
The number of companies, the check size. We have fewer companies in Fund 2. Check size is bigger.
What was the number of companies in Fund 1 versus Fund 2?
Fund 1, I think, is 38, 39. Fund 2 will probably end up being 28. And then we do the carve outs for crypto, which is its own world. And we'll tilt more initial dollars. So 65 to 70% of dollars are going to initial investments versus follow on. And I think in Fund 1, it's probably like 55-45 from a dollar basis. God willing, loss ratios will come a little earlier in Fund 2, I think. Like Fund 1 was, into that ZERP area, and it took forever for a lot of companies to be sunsetted, which I think is not good for the ecosystem and definitely not good for small managers. And the biggest one's team, right? Like nobody on the team today who's investing besides myself was on the team when we invested Fund 1. And so we have more smarter people around than before.
Besides team, like what was the impetus for making those changes?
At the beginning of a fund, I mean, you see this in the things we post publicly, right? We have like a thesis database. We talk about a bunch of different areas we think have companies that should exist. And I think if you look at a fund, like you kind of go in and you say, okay, for us, so we take a really long time to invest. We're probably the slowest deploying seed venture fund in the United States over the past 5 to 7 years. Like our first one was 2016 vintage. Our second one was 2021. Our next one will be 2026, knock on wood. And we realized that we are good at having very high conviction on a small subset of things. We're not great at getting conviction often. And so 38 companies just doesn't make sense in that sense. Even like 30 is pretty tough. And so I think there's that as a first order mechanism. The second is we did a bunch of data analysis on our portfolio, friends' portfolios. Some of our LPs gave us data, and we basically looked at like valuation ramp in areas that we invested in and saw that like post Series A, the valuations ramp pretty materially, like Series B and sometimes these in between rounds. And the canonical like wisdom of venture of like deploy money into your winners over time maybe makes sense if you're doing like enterprise software where you have ARR that scales more predictably and it's not like these chunky contracts that convert and you don't have as much like technical risk. But for us, like these companies don't de-risk in kind of a normal way. And so we should be concentrating capital as early as possible. And so that's why like our general rule is we try to make sure we concentrate a large percentage of our dollars pre-Series B. And that sometimes will mean buying secondary post-Series A, but it means making sure we enter a position at seed with the understanding that's going to be our maximum ownership, and then we'll take dilution over time. Typically, we model about 50% dilution over lifetime of a position. And I think that a lot of people in venture have like backward-looking views on the world. And so they have these rules that are kind of like truisms that are, perpetuated by the massive LPs that have been doing this for a long time. But like venture from basically 2018 forward is an entirely different asset class than it was prior. And so a lot of these rules that people think are how venture should work from a mathematical perspective are, in my mind, like entirely wrong. And the secondary thing is that like you also have the like 2019 to 2022 vision of the world of venture, which is people also think the outcomes might be bigger. And they might be on like an inflation adjusted basis. They might be on, there will be more, whatever, $100 billion companies, but the velocity and the percentage of those is actually not, I think is overrated. And so a lot of our underwriting comes down to within realistic bands of outcomes, where I think a lot of other VCs kind of started to look at the world and said, well, I'm probably going to have a $10 billion plus outcome if it works. Like that's going to be the biggest, my winner will be 10 billion or more. Thus the math will work this way. We model the biggest outcome in our portfolio as being $2 billion. Luckily we have multiple companies that are larger than that now, but like, I think that that's like a realistic thing that you should be targeting if you're a seed investor, especially if you're basically like us who's saying like, we won't do a bunch of areas. So if you kind of look at like a statistical view of 60 to $80 billion companies are built every year that exit for $1 billion or more, how many of them are in AI, ML, robotics, bio, crypto, and whatever, some other weird adjacencies, like maybe it's 10, maybe it's 5, maybe it's 20. And thus that then means, you better be really good at what you do. And I think if you scale your fund size too much, you will maybe need to be in like 80% or 50% or whatever of all opportunities that could return your fund. And I think we're pretty good at what we do, but like, I'm not delusional.
What are some other truisms that you think are actually not true, apart from the size of outcome or likelihood of entering into those companies?
Oh man, there's a lot. Let's see. What are like the things people say that piss me off? Yeah, I think like portfolio construction, like so many LPs try to push people towards like, I think some LPs are smart because they understand they want like a terminal ownership, right? They want to see through into owning 1% of your best company. So they want you to own 20%, whatever it is, right? If they own 10% of your fund. It's actually like somewhat in conflict with a lot of GPs in the sense that you do want portfolio theory. Like it's great that as an LP, you think I should have 16 positions, but like that's terrible from a portfolio theory perspective for the firm. Again, it's great for your fund, maybe. I think we had a few different LPs who like in 2019 kind of gave us shit because we didn't have enough unicorns in our portfolio yet. This is a 2016 vintage fund. And they were like, oh, well, these firms have whatever. And it was like these firms that had, for lack of a better term, like shitcos that like raised a bunch of money and got big valuations and now probably are out of business or recapped. I mean, people like to say venture takes a long time and then everyone gets really impatient when they look around. The reserve strategy, I think, is one. Yeah, I don't know. I think the pattern matching one's probably the big one as well. I think that's one that like VCs lie to themselves about.
There's a lot of folks who do want to be the first person to invest in a certain category, but once there's a big winner, then they're going to invest in the category, and it sometimes is too late at that point.
Yeah. Like I think there's a few firms that understand this really well and have made a lot of money doing that.
The number of crypto exchanges people invested in after Coinbase seems really high.
Yeah.
Are there any patterns that you think hold true?
You have to have good ownership. I think that's the only one. Like what that means is so nuanced, but like, yeah, I just think you have to have good ownership. That's probably the only one that, and it's not even because you can't work. It's just because of like, again, if you're building a firm, like you have to be built around consistency over a decade of investing, right? And so, and if venture is so cyclical, you need to have that consistency to make sure that when you hit the cycle, you have the right ownership. There are some firms that like, or some funds that like had 6, 7, 8 unicorns in their portfolio, and they're like 2X's. And it's like you picked early stage $8 billion companies, and your investors are getting back like 1.5x after 10 years. And it's because you like wrote 75K checks at like 30 mil post valuations in 2018 into these businesses, or 2016. Like, what are you doing? And so I think that there's like, those are the main things. Probably the other one is like learning when to sell is a big one. There was a truism, which was like, you're not better than the power law. I think Mike Maples used to say that a bunch. Don't ever think you're smarter than the power law. The power law humbles us all. Sometimes you should just sell to give people back money, and the incremental 2x on the money is not the right risk-adjusted investment to make if you have the opportunity to sell.
I want to dig into some of this stuff you talk about research, because I know you talk about this a lot publicly, and everyone likes to talk about being thesis driven and doing research and things like that. You guys clearly do that really well, given how early you were to certain themes. Using Runway and Wave as examples, can you just talk a little bit about how does a specific area of research even get started before you're even thinking about making an investment? Then how does it turn into a first investment?
So as a team now, I guess maybe like prior to having really kind of like a team, I think a lot of it was like we just spent a lot of time reading research papers, and that was like what I loved doing. And a lot of it was because like,
how do you even know like what research papers to read? There's like more research published every day than anyone can read in a lifetime.
One, there used to not be. There used to be like, used to have things like Archive Sanity, and there were a few other different, there's like Model Depot. There's a bunch of these like paper tracking things, all of which have kind of died off hilariously when they should be, they would be best. There's a thing called Assert that I tried to find the guy who made it for years, and then I found him and he was like, yeah, I don't want to do this anymore, sorry. But it aggregated papers, and what you could do is there's a slider, and the slider had GitHub logo on the left side and the Twitter logo on the right side, and you could slide, and as you got on each side, you'd get either like the most hyped papers on Twitter or the most like forked papers on GitHub. And you could then like search across the different categories of archive, whether it was like bioarchive or, the CS ones, obviously the biggest one, AI ones. And I would just kind of like spend like, I don't know, 2 hours a day reading that stuff and just seeing. And I think it's kind of like immersion therapy. Like as you just keep doing it over and over again, you start to notice patterns, and you get really good at like, okay, this is something I should read. This is something I shouldn't read. And you build a list on Twitter of people to track, and you start to understand the best labs, and you have a few friends that are like really smart in given verticals, and you kind of just ask them like, hey, what is the most interesting research that's been happening? And you kind of just start to notice like little breadcrumbs of things. And I think, the story that I've told now a few times is like, we just spent the most interesting thing in AI in 2016 was the fact that you could generate images of humans with an AI model, and they like looked at the time pretty good. And it was from a new architecture called the Generative Adversarial Network that Ian Goodfellow created. And the idea was like, take two models and have them try and fool each other, and have one try and fool one, have the other one try and catch it. And what you would do is over time, you create a higher quality image such that the model trying to solve if it was fake or not couldn't tell. And then people started to apply that to new types of data sets. And that was like these research labs in Tokyo, and they started doing anime. And that was just like really cool. And so I started reading a bunch of those papers, and you started to see how, that paired with like computer vision stuff made these like, AI enabled VTubers. And over time, it just became pretty clear that like over an 18-month period, the most progress I saw in anything in AI outside of basically deep learning applied for like object recognition, which companies like Clarify, and others were kind of building around in that time frame, was this creative stuff, image synthesis, body tracking, whatever. And there's different labs that was doing kind of different parts of this research. And so it felt to me like if you ask people, they were like, creativity is the core of humanity. Like AI is never going to solve that. That's ridiculous. And I was kind of like, people are solving it already. There's a bunch of people with they just don't have good data sets yet. So I met the Runway guys, and they were at NYU at ITP, which is kind of like I would simplistically call it like a program for creative technologists, a graduate program. And I DM'd them on Twitter and was just like, hey, like you guys are doing some cool stuff. And they had this project called latent space labs, I think, where you could type in text and then you'd get an image generated of the text in this like kind of nice UI. And I met them at a coffee shop and like meat packing, and they're like, this is what we've been building in our graduate program. And it was like a fully featured software to enable open source models to be used by creatives and non-technical people. And it was the best demo I've ever seen in my life for 3 people who were at college. Like it was like they were professionals. They had jobs. It was a graduate program, but like it was pretty early. And so we did the seed round, and I think the learning was just when you start to see the breadcrumbs, you want to invest ahead of it becoming obvious, and also you want to be willing to extrapolate the like progressive curve of how these things move. And I think that is the core to an investment like that, where you're just kind of extrapolating singular data points into many others, and that's what VCs do. And I mean, most of the time you do it incorrectly. Sometimes you don't.
Were they already set on building a company in this space, or were you part of like the nudge to do that and to go from research to company?
No, they knew they wanted to start a company. They're killers. And so they knew like they wanted to build a generational business, and how they were going to do it, they weren't entirely sure, but their premise was AI is going to disrupt creativity, and Runway is a company that is going to enable that. They meandered quite a bit for 3 years through that vision, and eventually I think settled on getting to a point where they kind of had that bet the company moment. And I think that's another learning that happens in a lot of these deeply technical, kind of highly speculative areas, which is these founders have to figure out when they move into those bet the company moments, because capital will dry up otherwise, because you need to kind of hit some sort of commercial and or product centric inflection point. And so yeah, they did that. And obviously now they have Gen 3 Alpha and a bunch of amazing companies work with them. And yeah, they're incredible.
Yeah. Every time I see one of their new employees post like their own demo, their own like experience using the products on Twitter. First of all, I love that as like a team building, like welcoming, onboarding tool. But then also it's just like a great way for the rest of the world to just keep seeing how much better each version of the product is.
Is there I guess the areas that you're investing in, there's a lot of these like scientific folks who are doing research. Is there a specific thought process that you have when evaluating companies of like, how do I go from this being a really cool science or research project to being a generational company?
Yeah, I think you have to know a few things, and you have to kind of not know a bunch. The main one I'd say is if you're in academia or you're doing bleeding edge research and you're incredible at it and you like it, you will not be building a generational company. Because if you enjoy the structure that academia provides you, it's just not going to be a good fit. And academia is basically like a euphemism for a bunch of things as well. It could be working at a large, big tech lab as well. And so anyone who's not basically terribly tired and angry of being at that place, I probably won't underwrite. The generational company thing, I think, is one of our big beliefs is as venture has become so good at moving towards risky things, which wasn't the case a few years ago, but has now. And I wrote about this recently in a post. Like, I think as it's become so, movement seeking, you have to be too early. Like, you have to be doing things for us as a small seed fund that has a very good chance that you're just too early and you were wrong. Like the curve didn't bend as quickly as you thought, and the company just dies because nobody's going to give it more money at Series A or Series B because the technology readiness or the industry around it or whatever hasn't matured. And VR is probably a good example of that. We've been expecting VR to come for 10 years now. I think AI was an example of that up until 2022. Robotics, I think, has also been an example of that. There are a few successful robotics companies. We're really excited. Like Hyphen in our portfolio is just kind of starting to scale in that way, but it's still really early and like it's been years.
Has that changed the way at all that you guys do research?
Yeah, it's moved to framing from, do you see a mass of breadcrumbs that prove this thesis is correct, to do you see a small collection of them that prove that this thesis is possible, is kind of the most simplistic distillation. And I think what that then means is like, you have to believe that you are backing people. And because of the rate at which people spin out now, they are backing ahead of overwhelming consensus on them being right. And there's plenty of money to do that, by the way. And so you have to believe that companies now are going to be as much involved or more in solving unsolved problems as it is in commercializing them. Where I would guess 10 years ago, most people in venture kind of thought it was stupid to be doing a lot of deep tech, frontier techy stuff because they're like, these are science projects. It doesn't make sense. And the only difference now is that still is kind of true. It's still the same thing, but is can people being singularly focused on a problem in a entity with pressure accelerate the time at which something can be done? And are the people leading the companies, the founders, the C-suite, whatever, uniquely good at figuring out how do you either accumulate so much capital that you have the time to solve these really previously unsolvable problems, or figure out how do you sequence to providing value over time such that you can continue to raise money as you provide, incremental or whatever step functions of value. And so one is like, the OpenAI playbook, or theoretically a bunch of other companies that have raised a ton of money and then failed. And the other is maybe like the Tesla Elon playbook of you sequence up the curve of technological development, but you generate revenue along the way. Very few people can raise money like Sam Altman can. And so I think there's a feeling that a lot of people think that that is the way in which one should build these types of businesses. I am highly dubious of that. I think what it does is people get large chunks of first money because investors are dying to put money into certain types of ideas. And I think that the things blow up 18 to 24 months later because founders will spend money and companies will spend money at a rate of every 24 to 36 months, regardless of the amount of dollars that go into the bank account.
You guys do a lot of with OneRate, for example. It sounds like you found some of the research, you found them on Twitter, you reached out, and I know you do a lot of writing and speaking in terms of like your research, your theses. That surely serves as marketing to bring founders in who are working on certain areas. What does the sourcing end up looking like for you guys, top of funnel, as well as in terms of who you actually end up investing in with regard to, outbound versus inbound?
Yeah, the answer is kind of boring. It's probably like 60% outbound, 40% inbound, I would guess. Maybe 50-50. I think for us, there's a lot of like what I would call like the incubation phase, and not in the traditional sense of how VCs talk about incubation in the sense of building companies. We do that, but not at scale. But more of just like, there are a lot of people doing really interesting work around areas we care about. And so we'll just spend time with them. Mackenzie on our team, who's our researcher, his main job is like figure out who are people doing the craziest, weirdest things in the world and understand kind of how they think about timelines, what they think could happen, what they think couldn't happen. And we all do that in our kind of areas of focus. And we all do that in areas that we're passionate about. And I mean, Alex at Wave, like I met him 2 years prior to him ever starting the company because I read his PhD thesis and emailed him. And yeah, like just so happened 2 years later that, through one of our venture partners, we heard that this guy, Alex Kendall, was starting this company called Light Blue Labs and now Wave, and I should talk to him. And so I just bumped my email thread from 2 years prior where I was like, hey, your thesis is sick. This is like really cool work. Like, what are you up to? And the prior email was him being like, thanks. I'm just like trying to get my PhD. Like, appreciate it though. And so I think there's now, back then, especially in London or the UK rather, he was at Cambridge, there was less of like an understanding probably of like the, hobnobbing with VCs in the research communities. Now there is much more of it, which is annoying for me, but also in some ways better because people are more willing to have these conversations of understanding, how do VCs who maybe have seen similar types of businesses been built, science-driven companies, research-driven companies, whatever, how do they think about the world? What do they think about is important? And you talk to some like really sophisticated kind of founder minds who are like very early on in their PhDs and they're thinking like, yeah, I'm at this great lab. I chose this lab because they pump out great companies. And my goal here is to do a bunch of research, then figure out what is the main thing I want to go and spin out. And it's like very sophisticated relative to 5 years ago. The complexity is that like that sophistication means you also get a lot of like false positive signals. Just people will get, it's similar that, you guys see for other areas, like people get very good at pitching and they get good at pitching their company and the story. And you thus have like more bullshit to sift through, where I would say like, in 2016, 17, 18, it was interesting being an investor who was spending a lot of time in London, but, our main investments were, New York, California, Boston, whatever, because the main thing, like the biggest difference was like the founders in the UK were very honest and very like matter of fact and open. Like, yeah, this might work, this might not for these reasons. And you went to San Francisco and now it's dialed in even more and you just felt it. And so that's something that's definitely changed quite a bit.
Do you ever have to hold yourself back from talking with these folks and being like trying to push them faster to want to go to market?
Uh,
Or are the people that you're talking with typically of the mind that they want to build something already?
Definitely not. So like the big learning for everyone who joins Compound, I think, I would say like there's a lot of VCs who do our style of investing in like very specific ways. Like I think biotech investors are incredible at spinning out single assets out of large institutions, whatever. But the main thing that everyone at Compound learns is like as you spend time paying a bunch of researchers, you like effectively like quote unquote waste your time like 85% of the time. Like there are so many times where I've flown to San Francisco, pinged someone who wrote this awesome paper. I was super excited. It was so clear how it could be a company. And you sit down for coffee and like 15 minutes later, you're like, oh, you will never start a company and you have no desire to. And I can't even tell why you're talking to me. But I also think it kind of goes back to like one of the truisms of the world, which is people doing really niche things, like never have people who like them, who like not them as people, but like the niche things too, and like want to talk to them about it. And so there's some really weird stuff where you can email people who are one of the 50 most important people in the world in a category and be like, hey, I want to talk to you about this. And they'll respond within like 4 hours with, hey, here's my availability tomorrow, Thursday, and Friday. And you get on the phone and you can ask them a variety of questions. And I think candidly, as you get older and as you kind of progress in your career, those conversations become a little harder. People are a little more skeptical of you. That's something I've felt. But yeah, I think I don't know, the outbound motion is something that's very core to us. And it's why we spend so much time limiting other bullshit that takes up time. Our main thing is like I think I probably take fewer meetings than many other VCs because like I'm probably like misallocating quote unquote time doing other more research centric stuff quite often.
What does that number look like for you, to be more precise on like fewer?
Take like at most 2 to 3 pitch meetings a day. I would say I like effectively refuse to do things in the evening with VCs unless it's like, yeah, I've decided for some reason I need to. I don't go to conferences, even the main like industry conferences, which I probably should go to. I don't, because I think I'm much better kind of sniping one-on-one stuff. Yeah, I just like, I don't do kind of, I don't have any of the like set up recurring calls with people. I think like I try to limit that for a very small subset. And like my venture career has been built on like who are the 10 people that I want to spend time with, and how do I just make sure that that's like a very open channel and very communicative, and everything else doesn't matter. And we all get those emails of like, hey, like, love to catch up on this random thing. And it's like, oh, your CRM bumped me this quarter. Like, all right, I get it. Yeah, I don't know. Those are the main things.
Is there a specific point in your career where that you saw that change, or was it just a function of you moving to partner and having to do other things related to just the day-to-day of Compound?
No, I think I would have probably gotten fired from like most large full stack firms today. Yeah, like I don't think I could do what the real job is in venture anymore at the junior side, like, or ever actually, not anymore. Yeah, I think it's just like try to play into strengths. Now it's become even, it definitely becomes harder because you have to you do LP meetings more, and so I try and do that on a more regular cadence. But I also think that the nice part maybe is that because we invest over long periods of time and we invest in fewer companies, we also do have the ability to kind of like time manage portfolio. We don't have like, some of these solo GPs who, raised fund 1 and then raised fund 2 18 months later, and then fund 3 12 months later, and they invest in 50 companies per fund. It's like they're sitting on 125 active positions just themselves after 3 years. And sure, the founders probably don't expect much from them, but like I find it's like unruly. And we've had 2 funds over whatever 8 years, and like we have maybe 40 active companies.
Your context per company is probably way higher than the average VC, and I guess that translates probably to like time spent with each founder.
Yeah, I think so. I mean, but also I do think a lot of VCs try to be helpful in times when they can't. And so I think maybe the nice part is there are times in which we're on text threads with all of our founders, and we meet with them every like 2 weeks, generally, sometimes once a month, depending on stage, whatever. I think I'm on 8 boards right now, and then I'm an observer on a few others. But like, I think in general, there's times in companies that there's not much we can do. Like the best thing we can do is help them think through longer term strategy things. But in the short term, if someone's doing hardcore science, like, I'm not going to step in. I might help recruit, I might help close a candidate, but those are very ad hoc things. And I view my job in those moments as just I say this every time, like equity compensated therapists. Like our only job is to be a partner to those founders as they like navigate these things and help them answer or get asked the right questions. And like, that's not that heavy of a lift, despite how much VCs would make you think like that is a heavy lift because we want to feel self-important about things. I think that there's like very tactical times. And I think especially as companies scale, that's where it gets really intense. The time spent is weirdly like, yeah, it's a power law in some ways at times.
Do you find yourself spending more of that time, I guess, like till a company's at Series A, or is there a specific point kind of in like the growth of a company that you realize that you're just not going to be as helpful as you have been in the past?
I try to come off of boards either at or after the Series B. The only board that I'm on to this day for a later stage company is Wave. And yeah, I think hopefully I'll die on that board. I think that there's just better investors to help these companies. Like I sit on the board of Wave with Seth Winteroth at Eclipse, and I watch how Seth works with the company, and it's a different skill set at this stage. And they are very good at what they do. And there are other investors that are terrible at that stage as well. But like either way, it's just a different skill set. And my view is there's very specific roles I play on that board. There's roles I play on other boards as they scale. But like there's a reason why there are professional investors who focus at later stages. And I used to be a public market investor, and there's different skill sets. I just don't think it's the same. And I try to recognize that and not have an ego about it.
You've high conviction in a lot of your thoughts, your beliefs, especially some that are very contrarian. Where do you think that conviction comes from?
Being an egomaniac? No, I don't know. I think I just study, like I care about the craft of like investing a lot. And so I care a lot about it. And I try and understand how, different people's viewpoints on it. And I try and do it across a bunch of different types of things. Like an example that is not related to this, but like during like the direct to consumer boom, whenever that was 2018, 19, I spent a bunch of time just going around to like those best investors in the space, the like forerunner types and some of the earlier stage ones. And was like, explain to me how you know how to do this. And it kind of came down to like, none of them had great answers. They all kind of said like, you see it and there's taste. And then on the later stage, you start to see, quantitative metrics to understand virality and, different type of cohort analysis and efficiency and whatever. But on the other stage, it was like, just taste. And I think there's a lot of things that like, I try to very deeply and intimately understand. And I think for me, like investing is a craft. And what that means is that it decays and it needs to be worked on at all times. And so I just try to do that. And like, I'm just very obsessive about it. And I think I'm very high confidence, but I'm not like immovable. I mean, I don't know, maybe I am, but I think I'm open to other data points.
Just the fact that you're even like second guessing whether you're immovable is clear that you're not, right? Like you're I think I've witnessed you be very open to say like, I don't know, this is not something that I know enough about. That kind of like, there's a healthy ego for the things that you know well and you've studied very closely. And then there's none at all for the things that you are not that interested in or haven't spent much time on.
Yeah, I think that's the hope. I also think as you do venture more, like you run this like, you have this curve where you have no idea what you're doing and you have like no idea why someone's entrusting you with lots of money. And then you start to get like minimal feedback loops. I think for me in my career, there was like a few things like early in my career, I got to see like what it felt like to lose like $1 million+ in a day. And that's like trading publics, right? And like, that's like a kind of like a fundamental moment as someone who's, doesn't grow up wealthy, never saw that type of money. You kind of just like get some sort of like emotional smoothing that comes from those types of things. And then I think in venture, you kind of start to have these, you got to see a company that you thought was going to die, not die. You got to see a company that you were so correct on die. And you're like, you have these things. And then hopefully you get the feedback loop at the end, which is, you saw something, you were correct. And thus you start to have slightly better training data for making decisions and slightly more confidence. But like navigating the wilderness of that, like 2020 was like pretty dark for me. Cause I think in general, that was, we were 5 years into compound at that point. The market was like crazy. It was COVID and I was doing well, but we weren't like having $5 billion SaaS companies with 10 million in ARR, like whatever, scaling like that, which, in retrospect is thank God. But I think it was a time where we kind of looked around and we were like, I think in general as a firm, Compound, we believe we are some of the smartest people. And I think we definitely have some semblance of arrogance around that. But I think there were moments where it was like, oh, wow, are we actually the idiots here? 2021 was great for me in that sense, because that dynamic maybe flipped a little bit. But I think that like you have these like kind of parts of time where you just have to get comfortable kind of walking in the desert alone. And I've had that in investing too, where I've made like, there's been 2 years in my investing career where I made 2 investments in December, 2 in January, and then like none for the next 11 months. And so maybe I'm just like more okay with the vol of this stuff. And that allows me to be a little bit more open to being right or wrong and slightly higher conviction, but maybe I'm just an egomaniac. I don't know.
We've talked about something related to this, which is you are a very prolific poster of your thoughts on the internet. What gives you the, I guess, just confidence in thinking to be like, I'm going to put this out on the internet. There's going to be a very clear trail of my thinking, and you can call me out on it if I'm wrong in the future.
I think at this point, it's not confidence. It's just like, why not? Like, it's so unbelievably valuable. Writing on the internet is the only reason why I have a career, like full stop. And I think that if you can continue to do it, you are helping yourself, you're helping like a million things. And I think that the thing too is like, we don't punish people for being wrong in venture and in tech ever. But we bury the dead quietly, as Anand at CB Insights used to like to say. And so it's like, you can write 20 dumb things and you can write one thing that is smart and everyone will think you're a fucking genius. And so like, if all you need to care about is like, how do I make sure that when I'm thinking about something, I'm doing it in an intentional way, and when I publish it, it feels 85% of what I want it to be, because that means you published it. And if you try to get to 100%, you'll never publish it. That, no pun intended, compounds over time. And the main thing, like everyone always asks, like, how do you spend time writing? How do you write whatever? And the fail safe for everyone is they're too precious about their writing. And there's times where I'll look back at old stuff and I'll feel really good about it. And there's times where I'll look back at old stuff and I'll be like, wow, this is a stupid ass thing to write. And if you don't feel that way, then you're probably not writing enough and you're probably not growing enough. And I just think in venture, especially, like there's so many people in VC now and they're all kind of the same and are like, our money is a commodity. And so how do you build surface area and how do you have someone feel who you are as a person and your thoughts and do it quickly and be able to do it asynchronously? Writing is the only thing. Podcasts or other forms of that, other types of content. But my main thing that I tell everyone is write as much as possible and write for your team too. We do a bunch of internal writing and that even helps because venture firms are incredibly decentralized and people don't talk that often, even though they might all be in an office. And so I think just trying to push on that, it just feels very like positive expected value.
I think there's a statement you left out or a thought you left out, which is like, if you're right often enough, it's good to keep putting your ideas out there, because there are a lot of people who say really dumb shit and
yeah,
I don't think it's helping them, but they just continue. And I think we've seen a little bit less of that post 2020, 2021, as some people out, questionable things are now like deleting what they've put out there or trying to explain it away as they get called out or things like that.
There's definitely like a mystique. There's a mystique destroying component of it, which is I don't think anybody doesn't know what I'm like at this point, like who I am. And there's a lot of investors that have a mystique to them. And you're kind of curious as a founder, I'd imagine, probably less so as an investor who's been doing this a bit, but like there's people who you're kind of like, oh, I wonder how do they do their job? How are they good? Whatever. And sometimes people then start writing or they start doing podcasts and you're like, wow, that is not the person I thought that was. So yeah, there's some calculus, but it's better to find out now that you're an idiot than 20 years from now. So like, you might as well do it. I don't know. just do the thing. And if it works, it works. And Kevin Kwok his famous pin tweet was like, Twitter is tapping a tuning fork and seeing what resonates. And I think writing is very similar in that way.
I want to shift gears and talk about fundraising, both to founders and then also you as a GP. You've raised 2 funds before. You spoke about it a little bit, but can you tell us a little bit again, just the size of the funds and when you raised them?
First fund was a $48 million fund raised in 2016. My partner, David, was heavily involved in that fundraise. And the second fund was a $73 million fund. We had kind of turned over my role as managing partner for that. So I spearheaded that fundraise that was raised in 2021. We closed on $60 million, and then we added incremental capital about a year after close because we did not invest very much from 2021 until 2023.
And so not investing that much made you want to add some more capital in because there wasn't as much progress and it was like a fresh fund still?
Yeah, it was still very early in the fund cycle. We had an LP that we really wanted to work with, who we think we'll work with for a long time, who came to us and kind of said, hey, when are you going to raise again? And we kind of said, we just raised and probably won't for another 4 to 5 years. We talked to our existing LPs, and I think it made sense for us to have a little bit more scale and the ability to write slightly larger checks than we had been writing. And yeah, I'm very glad we did. I think, this level of fund size is very comfortable for what we do and how we like to operate.
How many people did you have to go to raise that first fund?
Quite a few. Again, I was less heavily involved, so I don't have like a great number. The second fund was probably a better, more indicative, which was maybe 75, 80 people, could be more.
That's like how many people you had to do like a first call or first pitch with?
Yeah, I would guess probably, yeah. Because there was a lot of people who also we were kind of tracking us and wanted just an update in general, but we didn't actually think would be even participating in fund 2 because of size, because of early track record, because of they didn't know me, super personally. So I think you do a lot of those meetings with the expectation, again, to building a firm versus a fund, of just building that relationship and getting a touch point of okay, I get the full story, not just the deck or whatever. And it allows you also to tune and understand different types of LPs. And I think for us, as our LP base is partially institutions, probably 30 to 40% institutions, probably another 40% institutionalized family offices that have large teams and CIOs, and then 20% more less sophisticated family offices, for lack of a better word. I think it also just helps us to understand the different players, understand how they think about the world, and also for us, candidly understand what we want from our partners. I think it became less and less clear that certain types of models were what we actually wanted as partners in the LP stack.
What would make someone undesirable in the LP stack?
The best part about raising funds kind of through cycles, right? We raised 2016, which was different than 2021, which was maybe more top near cycle, but then also being able to re-engage in 2022 when this new LP came on has been allowing us, and then seeing kind of the market collapse. And, we got to see 2 cycles of that in crypto and how our LPs reacted. We got to see how LPs thought about that from a tech perspective as well. You start to understand people who are actually high conviction versus aren't. And to, LPs, again, our pitch to an LP is Compound is an institutional grade firm in the sense that we believe we, as a firm, will continue to deliver great returns that make investing in any fund very good. We believe that on a given fund, because of how we invest, the stage we invest, you could have very, very good returns, very outsized, the things that we think fund 1 will be. And there's a lot of people who just aren't going to do that. They're going to choose conviction when prices are highest and lose conviction when they're lowest. And we have some LPs that are very sophisticated public market investors or private equity investors, and they're founders of really large firms. And them asking us about crypto in 2022 was them saying, well, you have conviction, you've always had conviction. Why don't you double down? Why don't you buy more? Do you want to open up a vehicle to do more crypto investing? Where a lot of maybe more traditional allocators who are to the point, maybe lagging indicators of the industry, were kind of giving us shit for our crypto exposure. And I always say that the conviction from the broader LP class directly traces the price of Ethereum for crypto. And I think that also happens for a lot of tech. And the reality is if you don't believe that innovation is a multi-decade trend that will have the possibility to generate outsized returns, and you don't want to consistently be there, you just shouldn't talk to Compound. And so we think a lot about that as it comes to how we talk to LPs and how we learn about their behaviors over time and their interactions with us. And I'm sure they do the same for us too.
With Fund 2, what percentage of those conversations with LPs were first-time conversations versus people that you already had built relationships with?
Probably 70% were first time. Yeah, maybe 30% were existing. There were some LPs that we started to get to know in 2019 and 20. So it was first time in the sense they weren't prior LPs and we had never pitched them before, but they had gotten to know us through an SPV or through, wanting to generally catch up. But I think the biggest mistake I probably made is I didn't do the always be fundraising, always trying to build a funnel thing in between funds. that's the best advice I've ever gotten. And I, just didn't have, I think candidly, I was just focused on trying to make sure I made good investments, that I wasn't optimizing for raising money, because one of those matters a lot more than the other, I guess. Now I think I try to make a more concerted effort. Like, I have a rule with myself that I'll go to one LP like conference each year, because otherwise I wouldn't go to any. And
what a big commitment, one a year. Really
yeah, I mean,
going all out here.
that is a big commitment for me. That's like my worst setting. I just shrink into the wall and, hope no one talks to me. And so I try to do that. And then I try to catch up with, I probably do an LP conversation every 2 weeks. So, you have a variety of them. And then we do an AGM every year where we get people together. And last year and the year before, I made it a point to invite prospective LPs that I would want to have in future funds to come to those AGMs, so they can understand kind of like the operational component of how we run Compound. And I think that day is probably like, the best condensed version of that. And we have a zine that we send to our LPs and then to our founders and stuff, and prospective LPs as well, that contains all of our writing. And so we're trying to do more things that are maybe asynchronous or like scaled, because I just still don't have that much time. And also I am really bad at doing kind of like the other scaled things like events. But yeah, a lot of new conversations.
That is by far still the best piece of, and I have no other word other than merch that I think any VC puts out. So yeah.
I appreciate it.
Do you think you converted better on existing LPs or new LPs for Fund 2?
I mean, existing is obviously always easier, but we had a lot of LPs that we didn't think would be like good partners long-term for Compound in the prior funds. And so we kind of had a view that we would rotate some of them. And that also meant like, I think all GPs, the goal is you want to like, everyone says like upgrade your LP base, but we wanted to be with people that did have that conviction. And I think some people view venture as like a punt, and others view it as an asset class that is durable in their portfolio. And so, yeah, that was kind of how we made those decisions. And there were also some that were kind of like, hey, like, I just don't really like, want to do more venture stuff. Like I'm like way over allocated to venture right now, and I just can't do anymore. And again, it was 2021. So like money was starting to come back, but it hadn't fully come in yet. A bunch of people were sitting on locked up, IPOs that the GPs weren't going to sell. So we definitely had some of those conversations too, where people were just like, on a NAV basis, my portfolio is like 90% venture exposed because I have a bunch of illiquid stock that I pray to God these GPs sell when it unlocks.
Yeah, that's how I feel looking at my personal balance sheet. I'm like, it's a really, really unhealthy overexposure to venture. But
yeah.
So it goes.
To that, I guess as a kind of extension of that, like when you went into that fundraising process for the second time, what was something that you were like, I fundamentally think that this is going to happen, and then during the process didn't happen?
Oh, that's interesting. We had actually a fairly large institution that was in our prior fund that didn't re-up for the next one. And they didn't re-up because, it's funny, they told us we were in the top decile in their venture portfolio, but they didn't re-up because they weren't comfortable with the shift of me moving into kind of managing the firm. And so they viewed that as like a new opportunity. And they were overexposed to venture and all the shit that fund of funds say. And so they didn't re-up, and they were maybe the second largest LP in the first fund. And yeah, and they had bought up, they were like very aggressive with kind of wanting to own things in the Compound universe, we'll call it, ahead of that. So yeah, that was weird. And that's probably the biggest one.
What was that, I guess, as you all were, did that happen kind of at the beginning of the process or later on? And I'm curious, as that call ended, like, what immediately went through your mind? Was it like, all right, fuck these guys, I'm going to go out and raise a shitload more money? Or was it kind of like, damn, that really hurts? Yeah,
I don't think it wasn't like we're going to raise more money to prove a point. I definitely was kind of like, fuck these people, but everyone's got to do their thing. I don't know. Like in the end of the day, it's probably better to learn that now that like, people are that way. I think for me, it was just, they took a long time. To your point, it wasn't an early part of the process. It was longer than they should have, probably. And so I think that was probably the disappointing part. I actually don't really care if people don't want to invest in Compound. Life is for lessons. Everyone can do their own thing. But I think if people just like run a process poorly, and it's the same thing we try to do with investments, right? We try to be quick nose, all that stuff.
One of the big learnings it sounds like you had from Fund 1 to Fund 2 is to stay engaged with LPs, even when you're not fundraising. Are there other things that you learned from the first race to the second?
Don't be apologetic or don't try and morph your story for LPs. This is like a first class thing to say, maybe, because I think you do have to a little bit, but the biggest pushback we get as a firm is, story. We're thesis driven, we're research centric, we're very deep. We care about all these things and we go incredibly deep on them. And then they ask how big our team is. And we have a, very small investment team. And their kind of question is always like, well, how are you guys so smart on all these areas if there's only 5 people at the firm? And so I kind of just stopped answering that, or I started answering it for them. And I kind of just said, listen, the need to believe on Compound is the way in which we spend our time is incredibly efficient and incredibly well allocated relative to our investment strategy and how we invest. And so you're underwriting our ability to do this style of investing best. And thus you have to believe that this style of research-centric thesis-driven investing is alpha generating in some way and will make a lot of money. And if you don't believe in that, then you are going to have an even harder part of the second side, which is that we do it better than anyone else. And then the last things are the fund sizing and things like that. And everyone believes in that stuff now. So I think it was probably just being very core to who we are. And I got advice on an AGM deck, or maybe it was a fundraising deck from Andy Weissman at USV once. I kind of walked him through our deck and I was asking for feedback. And he was like, you have a lot of provocative things you say in this deck. You need to just start with those as the first slide. And so in all of our materials, whether it's our AGM or our fundraising or a bunch of things, the main thing we do is we start with our beliefs. What is it that we believe in venture? And those beliefs are kind of like level setting, which is this is something that you need to have in your head if you hear everything else that we're going to say. And if you don't have these things in your head, a lot of this stuff might not make sense, or you might have doubt creep in, but I'm going to implant that up front, that this is the basis of facts we are operating from. And I think that was immensely helpful.
Was that hard to do the first couple of times that you had to do it?
No, because I think going into Fund 2, I kind of made the decision that we're going to go down on the ship that we're building. This is if it works, great. And if it doesn't, then at least we went down our way. And it's the same advice we tell founders: make the decision so you can sleep at night if your company fails. Having that recognition was kind of freeing. I think it's way worse if you're oh, I should have said it this way, and I actually feel this way, but I was trying to change it, and so I wasn't as good. And I also just think it's harder to have a real conversation if you're operating from maybe a place of moderate insecurity. So yeah, I don't know, that's how we approached it.
That's a pretty contrarian approach, but also feels like conventional wisdom, right? Just in terms of being honest and true to who you are. In this case, it sounds like putting that foot first is maybe the way that I would frame it. Are there other things out there that you see as advice that people give that you think is bullshit when it comes to raising a fund?
I think a lot of it is this. It used to be this you have to own 15 to 20% of a company. You have to buy up ownership over time. Again, these truisms that are just not rooted in the reality of how the market works. And I think it's very easy to have these investors who say there was a period of time where everyone was super amped on the studio model and incubation model. And it was we only want to do incubation firms because they own 40% and it's going to work great. And then you can make a lot of money. And it's who's 2 firms in the history. I mean, there's very few firms that have actually ever made money doing incubation at scale. And one of them's an evergreen fund in Sutter Hill. And the other one, CyberStarts, is vertically focused in Israel and has a pretty unique deal around how that, the customers work with their portfolio companies.
You wouldn't put Atomic in that category?
I think Atomic could be in that category as well. Atomic, I think, was the first small data point that made a bunch of LPs in the US be oh, this is possible to do a bunch of times over. And I don't know, I just think it's I think venture is not broken at its fundamental core of what it is, which is take a lot of risk and get paid for that risk. And people trying to reinvent the wheel, doing hyper overly efficient things in the sense of incubation and owning 40%, all that stuff are kind of missing it. Yeah. So I think those types of fly by night hot takes from LPs is kind of annoying at times. For us, we just try and also optimize for what is actually dominant for a founder. So one of the things we talked about to combat this idea of well, you guys are a smaller fund, how are you ever going to compete against the bigger funds, is if I'm a founder at the seed stage and we're super high context on a space, would I rather have insert random generalist seed fund that's $200 million or something have to write a $4 million check to own their 20% to make the math kind of work? Or would I rather have, insert Series A fund that maybe doesn't care that much about leading a seed round, but wants a small check and a compound and a few angels, and which is just better for the founder. And it's very hard for anyone to make an argument that the former is better. And so we try to frame it a lot as not we have opinions, but it's actually just what it's dominant from a market structure perspective. And we try to check ourselves in that as well. That's why we keep our sizing down, so we don't have to write really large checks, but have the ability to if we need to.
Is there any other advice that you think is wrong that's out there, or maybe misunderstood?
No, I think time diversity is a beautiful thing, and I don't get why more people in venture don't use it to their advantage. I get why. I just think time diversity is makes the most sense in a highly cyclical industry, especially when technology cycles are happening faster than ever in terms of technological development. So I'm very biased there, but I don't know. I think the reality is there's a million ways to do venture right, and there's a billion ways to do it wrong. And so you just kind of got to make sure you don't do the wrong ones, and then I don't know, you'll find out if you're good or not 20 years from now.
What about with founders? You're investing so often in the first round of a founder's journey, and a lot of times it sounds like you're the one funding them. How do you assess a founder's ability to fundraise? How do you help them with fundraising?
Their ability to fundraise is how much can they make sure that they have the ability to be translational. So if you look at our types of companies, typically are moderately hard to understand, maybe are built on or predicated on some sort of shift that is technological or science and thus complex. And communicating why that's important is a lot harder than, a lot of other types of companies, social, consumer, or whatever. And so if you can be translational and go from 30,000 feet down to, super deep and bridge that gap such that depending on the type of person you're talking to, I think that's incredibly valuable. I think it's a very rare skill set. One of the things we have our portfolio companies do on all their updates, and we send them a template for this right when we invest, is we make them explain how do they talk about their company to investors, how should we talk about the company to customers, how should we talk about them to potential recruits. And I think the ability to start to understand the nuances of that creates some sort of mechanism in which these founders are then thinking about this multifaceted storytelling nature at all times. The second thing is probably just pace. We think the best teams in deep tech are the fastest ones typically, or the most thoughtful. And there's there's two spectrums. We move super quick and thus we get more experiments into the world and learn faster than anyone else. Or we think super deeply, and when we run experiments, we run them incredibly well and we validate them or we invalidate them, and then we run the next one and it's a step function better. Anywhere in the middle of that, I think, is the death valley for building a deeply technical company that is really complex, because you also have the nuances of how do you then build research teams versus engineering teams, and we think a lot about team composition in these types of companies as well. And so we help them think through that as companies move from this point we were talking about, this venturification of research, as we talk about, which is they move from science organizations into companies. The things you optimize for, how you hire, who you hire, how you recruit changes, right? One year you care a lot about publishing. You care about making sure the world understands the research you're doing such that you can accumulate better talent. 4 years later, you care about being translational such that your customers can understand how your technology has progressed into being translational into a product. And the types of people that sit at both of those things is quite different. The way they operate is different. How you recruit is different. How they get compensated, whatever. So those are the ways in which we work with them and how we think about them and talk to them. And yeah, I don't know. That's the high level framing.
Yeah, the first one's an interesting one. I've heard people talk about that in a variety of different ways. We talk about it as being diversely persuasive. Can you speak to different stakeholders or constituencies in ways that are better for them to understand and move in the direction you want them to move in, whether it's through education or through another means? I hear people talk about it as resource magnets. You guys have probably heard that term, right? Can you attract investors? Can you attract talent? Can you attract customers? Each of which are resources, and another way to kind of express the same idea. The second point is also, I think, something that people talk a lot about, which is the speed of teams. And if you can't easily understand the quality of an iteration, you can at least understand how many iterations are you making in a fixed period of time, which means the likelihood that you find the right, the right product market fit or whatever it is higher.
The only nuance I would add to that point is that in prior generations of startup building, it actually didn't matter as much because you were building with much less competition. In
Yeah.
2024, any given company has 2 to 3 other venture-backed competitors at a minimum. And thus you actually are like, I would argue startups are more zero sum today than they've ever been. And we've always viewed them as positive sum. And it's always been this kind of very big, like we've always said they're oligopolistic. The largest company will become the most valuable. The second will be 10% of that value or whatever. But I think they are more zero sum in the sense that you're competing for a subset of investors and talent as you layer up the stack. And in deeply technical categories, you are supply constrained on all of those things. There are fewer investors that'll write the 20, 30, $50 million check. And there's a subset of talent in the world that can do what you do. And thus the pace of those things matters a lot more than building in mobile in like 2013.
I've also noticed sometimes like where multiple companies are building in the same space and they have a similar naming approach, right? So there'll be like 3 companies all doing the same thing and they're all like generic guy names, or they're all names of different flowers. And I'm like, I don't know which one of you was first, but clearly the other 2 of you are completely unoriginal and just trying to stay as close to the original as possible. Let's translate this more to fundraising for founders, especially thinking about your experience raising funds. You spoke about how important it is to stay in touch with LPs, even when you're not raising, and build relationships. That's advice that's given to founders, I think pretty conventionally, like talk to VCs when you're not raising, which is, easy for some founders to do, very hard for other founders to do. But there is also contrarian voices out there that say like, never talk to an investor unless you're fundraising. Where do you fall on that debate?
Yeah. So Kesar's partner, Mark, has an incredible post called Lines Not Dots. And the idea is that principle, right? How do investors want to invest in lines? They want to see that trajectory. At some point in 2020 or 2021, I wrote a post called Dots Not Lines. And it was around this premise, which is that I think that in this world, you do get to this point where you want to run an efficient process and you want to be the best version of yourself because you are being directly compared to your competitors in that moment in time. And I think that in most cases, at the early to mid stages, let's say pre-series B, you want to be pretty heads down in between raises, and you want to be only coming to the market when you have like a strong either narrative positioning and you want to test the market to raise money, or you have specific questions around how investors are going to interact with your company in the venture financing market. And what that means is like you go to meetings and they talk 90% of the time, you talk 10% of the time as a founder. I think if at any meeting when you're not fundraising as a founder, you are talking greater than 50% of the time, things have gone wrong. And I think that your entire goal should be how do you extract as much information and knowledge possible, whatever vector of knowledge you're looking for. I think as you start to become a growth stage business, you do have much more of a burden of proof because you have a lot of data behind you such that you already have the kind of line in the market. You maybe have pitched these firms before, especially as more firms become full stack firms. They meet with you at Series A and at Series B and at the growth stage. But you want to kind of get to a position where you're showing like the velocity of the business over long periods of time, that such that when you go and ask for a really large amount of money, people don't worry that money will be like misproperly allocated, which is kind of like maybe a simple distillation is at those stages, people are underwriting a variety of factors about a company. The early stage looking for like a singular thing that they believe. And you can convince someone on a single data point, a singular thing. It's a lot harder to convince them on a single data point, like 100 things. And so that's how I would delineate.
If you're a founder and you are interested in meeting with VCs to learn about how they're thinking about your sector, your technology, your strategy, and you're taking this 90-10 advice to not talk and listen, but you're having a hard time getting those calls, or on those calls you're getting asked to pitch when you're not ready, how would you advise someone to navigate that?
You should get if you've raised any money, you should get your investors to help. If you haven't raised any money, I think it's incredibly hard to navigate. I think you have to set the expectation ahead of time very clearly. Here are the 3 things I want to know. I'd love 15 to 20 minutes of your time. And you want to time box it such that even if you do end up getting, creeped up into talking 25% of the time, it's like 5 minutes, right? And so you want to have like a very clear, concise takeaway. And I think investors will, if they know it's not a pitch ahead of time, they will kind of work within that framing. I think if they don't. They just assume that this is like a soft pitch. It's like, oh, well, they're reaching out, so they must be actually, they're doing that thing where they're not fundraising, but they are. And so I'm going to just run through my list of questions. But otherwise, I think like your investors, the main job should be, we talk to each other all the time. We should have context on who are the right people to talk to. And then we should give those people the back channel context as well of like, hey, this person's not raising. This is what we want to know. And, you could just tell me, but I think you guys would enjoy talking for these reasons. So go do it.
What do you think about the fundraising, not fundraising move where it's like, we're not fundraising, but here's our deck and we have a data room? And
yeah, I think that's bullshit. I think it's like if you have the deck and you have a data room, you're fundraising ostensibly, and you're almost just hoping someone preempts you, which then you run the risk of creating market signal that nobody preempted you if everyone knows you talked. And again, we all talk. So if we meet something or someone that's interesting, or God forbid, don't friend these people on LinkedIn, you're LinkedIn connected to 20 VCs as a founder, and I inherently then know you went and talked to them, right? Mm-hmm. And so that would be my other advice is don't connect with VCs on LinkedIn. It's just bad data exhausting the world, unless you're, actually they're investors in your company or something.
I think I know where you're going to line up on this one for a variety of reasons, but what do you think about the advice to cram all of your meetings into 1 to 2 weeks, like 25, 50, 100 pitches, in a couple of weeks and do it that way versus cohorting over a few months and taking feedback, iterating on your pitch, going to a second cohort, a third cohort, like that? 2
cohorts. First one, like 1 week long to understand why things could be sharper, what major questions are. Second one, packed within a 2 to 3 week time frame, run a process. Yeah. I think anyone who doesn't run fundraising as a process, no matter what. I mean, when we raised our funds, we went to our existing investors and said, hey, you have, until January 7th or whatever to make your commitment. And after that, existing investors, the fund is like closed for them. And it's terrifying. And it's even more terrifying when you're raising a venture fund because no one person makes up more than 20% of the fund in our case. So, they're both not existential and kind of, you need that velocity. But I think as a founder, you only need one. And so your goal should be get people to the finish line. I don't think there's any investor that in week 3 will say no, but in week 5 would have said yes. Like you're going to push people towards their terminal decision anyways. So just get there.
And to your point, we all talk. And if you're in a position where you started fundraising a month and a half ago and you're just having a first conversation with someone, then they're like asking, oh, have you talked to this company? And they're like, yeah, we passed to them 5 weeks ago. Automatically as an investor, red flags are going off in your head because you're like, okay, what makes me special then? Am I just like the last person on the list?
I agree with you guys in general. At the same time, I'm thinking about a company I chatted with, 7 months ago that I know just closed a round, or at least they signed a term sheet maybe like a month, 2 months ago. They've just been in market for 6 months or longer because I don't know how long they were in market before I talked to them. In the current moment, at least, very different from a couple of years ago. Things are taking much longer. The market's much broader. There are investors all over the place, founders all over the place as well in terms of like the progress they've had, or they had like maybe like a plateau, but then they reignited growth. They had to restructure their team, different things like that. So it does feel like there's a little bit of a difference.
Were there like inflection moments over the course of those 6 months that helped them with fundraising?
I think there was actually. Yeah. There was one like a few months ago. They signed a big client and things like that.
And I feel like, especially in the industries that the three of us invest in, that happens pretty frequently where it's like fundraising will be, you start fundraising with the idea of, oh, we're going to close this contract in X number of months. And either someone will say, great, I'll take the risk on that, or they'll say, I'll see you in 3 months when you close that contract, and then we can go out and fundraise.
What are some of the most clever things that you've seen founders do in fundraising?
I had a founder a few weeks ago who sent me a custom GPT and was like, this is there's a bunch of information here. Just use this to ask questions. And it might be helpful for your early diligence or in conversations with your team or during like your first investment team meeting. I thought that was brilliant because it was also a pretty complex industry. It was kind of a weird industry. And there were a lot of those simple questions and they had data around it.
There's a bit of a leap of faith there too, though, right? That the GPT is not going to say something stupid or incorrect.
Yeah, for sure. But it was like, they had prompted with a bunch of data and then they gave the, specific questions that, to prompt you if you want to ask those, and then you could ask open-ended ones as well. But yeah, it's like, it was very smart. I think the FAQ thing, I think, is also really great. founders that build FAQs, it kind of shows like, I always think about this is a very like millennial coded reference in 8 Mile when he's doing the freestyle and he's like, I already know everything you're going to say about me. I kind of think about that as like founders doing an FAQ, which is like, yeah, I get that like 10 questions that all you VCs are going to ask, so here's the answers to them.
So are you a memo person over deck?
No, I think I think they're good in theory. Like I'm happy to get a memo. Any of our founders that is like, I only want to do a memo, I tell them that it's unfortunately just not optimal for fundraising. People want decks. They like the narrative of the deck. They like how compressed they are. And in most firms, the goal is, you can get a memo to the person who's going to be your champion, but the champion needs to sell to the firm, and it's not going to be through your memo. It's going to be through their memo, or it's going to be through your deck. And a lot of firms, the GPs won't read decks, which again, I think is fucking insane. But like, it's just the way the world is, unfortunately.
I always, whenever a founder brings it up to me, I always ask them like, "Are you Parker Conrad post benefits?" Because that's where I think a lot of this got traction. Right, it was like the Series A memo for Rippling, which great memo, amazing company, but that's not most founders. Yeah. And I'm pretty sure that round could have been raised without a memo or a deck for obvious reasons. And if that's not you, like, it just kind of looks, I hate to say it, but I feel like it looks lazy when someone's like, we have a memo, but we don't have a deck, because anyone can just write long form their thoughts. Not to write a really good memo does take more effort, but to make a great deck and to actually put your ideas into a very distilled, consumable format that's custom built shows that you have an understanding of what someone's trying to understand, and you can communicate well. And if you don't do that, you can maybe flex like, we don't need to do that. That's why we wrote a memo, or like, we're really good. But like, you're probably not if you're asking me the question, right? That's just the case. And I think there's a lot of things in that category where it's like, if you have to ask, you probably shouldn't be doing it. Do the thing that most people do and try and stay in the lane.
Yeah, or do both, right? And also like that's the other thing too, is as you do run go-to-market, or as you do other kind of like commercialization motions, like you're probably not going to sell that through a memo. You're probably going to make a deck. And so it just, it's a muscle worth flexing, for better or for worse.
How frequently do you find yourself like playing the role of educator for your startups during fundraising rounds with other VCs?
A fair amount. I think mostly just because of this, like the areas are so variable on the types of investors and what matters, and like there's less clear milestones. So we often are turned to as people that can help navigate those like very vast unknowns. And also I think in deep tech, frontier tech, whatever, like the goalposts move so much in a way that is less progressive and more extreme, and also relates a lot to founder profile, and also relates a lot to technical milestones and industry behavior. So I think you can think about bio as a good example, like computational biology companies, like people value the platform and then they don't. People care about the indications and then they don't. AI, it's like, do you care about the labs that these people came from or not? I think each of these areas has nuances that our job is to have a high degree of understanding of. And also I think it's, as some of our companies have raised a lot of money, it's been, people have wanted to understand those lessons more and more, and we can impart moderate wisdom from those lessons.
When a founder comes to you and thinks about that Series A fundraise or, large seed round, whatever it may be, next round of funding, do you find yourself pushing them either more towards specialized VCs at that stage or generalists, just in terms of their ability and platform to help with fundraising down the line, et cetera?
I don't think VCs create upside value in any companies. So it's not the platforms for that reason. It could be an individual partner at a platform. That's like great. But I find myself pointing them to specific GPs. And some of them they will understand this. Some of them, they're high conviction in this space already. Some of them they're incredible operationally. And these are the things that I think you need away from us. And sometimes it's, hey, these 5 people reached out, who's the best? And so I think it's pushing them to individuals, but it's usually just who's going to be really high context and like really work hard, not like this person's got an incredible platform team and so they're going to kill it for you. Like I don't think that stuff matters.
What do you think are the most common avoidable mistakes that you still see founders make when fundraising?
There's some on the early stage, like bad TAM analysis. I don't care about TAM at all, really. Like I know I want to know the fuzziness of how big it is. I'm not going to run some, analysis around that. And sometimes people do ridiculous things where it's like the ultimate TAM is the entire industry of biology or something. I think not having tight ranges around dollars you want to raise. You either don't give an amount or give a very tight range. If you're raising like 1.5 to 5, it just shows me that you don't really know how much money you need. And again, I think in deep tech businesses, money is incredibly important, and being precise on money is incredibly important because you have just a natural gravity of technical development and science development that means time is baked in. You're not going to go 0 to 20 million in ARR in 8 months. How people talk about like team, probably you have some of those things where people do the advisor, they have 20 advisors on the decks and they have them and their co-founder, and it's like we have 300 years of collective experience and we have all these things.
I love that one. That always gets me.
Yeah, those are the main things. I think there's other framing, which is, I think as a founder, you want to be maximally ambitious within reason. And so I think that's probably the thing that I find myself pushing on sometimes with scientific founders, is they're very methodical. And I kind of have to tell them like, hey, your goal, you're not being peer reviewed, right? Like there's no idea that you're about to have a group of people from Nature shred apart your research and then like disgrace you from the industry. You need to be maximally within reason optimistic about your ability to do something that no one's ever done before. And so I think our role often is weirdly being like cheerleaders for our companies and getting them ramped up to be able to, have the confidence, especially in academia, you're so built around being kind of beaten down that like you need to have the confidence that you are an outlier. So sometimes we spend time on that too.
I refer to that often as like underestimating investors' greed, which is that they want you to build the biggest company possible. So you need to be thinking about how you can build the biggest company possible, if that's what you want to do. And if not, you probably shouldn't raise venture. But if you want to, then you really have to talk about it in a way. And it kind of goes back to the thing you're talking about, sequencing, which is sort of like, the OpenAI versus Tesla example. If you're going to get somewhere far into the future in a huge company, it's probably going to be through multiple iterations of products and offerings. So what is the sequencing? What is the daisy chain that you can unlock today that then gets you the second step, the third step, all the way to step 10? I've also I think the competition piece is something that I still see founders, compare their future state to the rest of the world's current state. And that's like a little bit of a frustration for me. And then also kind of seeing like the case where there is not a direct competitor today, but then not being ready to answer, well, what happens when you have some success and everyone's like, oh, okay, that's a good idea, we should do that, which happens all the time, right? We were just talking about it in terms of like the bursts of companies that come together and people copying each other. And so that's another thing that I feel like is just not thought about enough by VCs themselves, right? How they're going to differentiate as well as for founders.
Do you feel like that competition thing though happens frequently, or people do that because they're trying to the point we talked about earlier, like help the VCs pattern match in terms of what they're looking for?
Yeah, I think so. I think that's fair. What you put in a deck is one thing. What you're ready to discuss is and have thought about is a second thing. And you need to have a little bit more paranoia, I think, than most founders do on that point, at least, which is thinking about, well, what happens when, large companies do what you're doing, which I think that was, it used to be something that was pilloried as a question, right? Like Facebook and Google are not going to do everything that all these startups are doing. But now we're seeing, right? Like, every OpenAI release, it's like there goes another few hundred companies that probably are not going to make it now because they don't have anything differentiated.
Yeah.
We got a couple minutes left. I got some fun questions. First one, you have to eat one thing for the rest of your life. What are you eating?
Does it have to have health impacts or no?
Well, yeah, it's going to have an impact on your health.
Oh, okay.
No. Okay, do both. Come on.
Okay, all right.
Yeah, non-healthy and healthy version, sure.
The non-healthy version is probably like a great burger and fries. The healthy-ish version, I don't know, like one of the like fast casual slop bowls of kava, sweet green, whatever. Like, I like that. It's good. I eat it a lot. Like, it's fine. I don't know.
Yeah, slop bowl sounds like you really love it.
It's literally what it is. It's just like totally undifferentiated, middle of the road, good ingredients. And I hate myself when I do it, and I hate myself that I enjoy it, but I do.
Well, when you make a bunch of money on Compound, you can open up your new fast casual restaurant, Slop Bowls.
Yes.
There you go.
What's been the best moment thus far in your career?
I think it's just like the collection of, I mean, it's just so like classical, cliche, whatever. It's just the collection of like moments with founders that you spend a lot of time with who like finally get to just be on the path of only executing. That idea of like they're not constrained by capital is they've earned the right to have the shot to just do what they want to do is like pretty cool. Especially since as a seed investor, you're just always terrified is there going to be more money to keep this company going? And seeing founders get to do that is cool. And team building, like it's really fun. I spend a lot of time with our team, and it's super rewarding. And they make me better, so it's fun.
So generic. I'll let you get away with it.
Yeah.
Who are you voting for?
Not Trump. Not Trump.
What's been who has been the most helpful person to you in your career so far, and what do they do for you?
I think there's a few. I mean, one would be my partner David, mostly because he kind of has given me the ability to take over a firm that he started and like run it and mold it into what I think the correct investment firm of the next 30 years looks like. I think my friend Andy Weissman is just like a very close friend, and there's no one who thinks about venture deeper than he does. And so we spend a lot of time thinking about that and him helping me navigate a bunch of things when it comes to firm building. My first boss, Rich Hahn, as well. He kind of was just like pushed me to do things that I enjoyed and loved. And I think that was very, very lucky and helpful that he was my first boss.
Awesome. Well, I'm glad all those folks helped you out and you got us to today.
Yeah. Well, I got to help some more people out, I guess.
Yeah. Thanks for joining us. We'll wrap it here.
Awesome. Thank you, guys.
Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.